Welcome to the deep dive. Ever thought about how your bank actually sends money overseas? Like properly across borders?
It seems simple from our end, right? Just click a button.
Exactly. But behind the scenes, there's this crucial mechanism, Nostro accounts.
It's a bit technical, maybe.
A little bit, yeah. But they're absolutely fundamental to how global finance works.
And, as our sources today point out, understanding them is also key to grasping things like international payments and, unfortunately, even some aspects of financial crime.
Mm-hmm.
So our mission today is pretty straightforward. Let's demystify these Nostro accounts so you really get what they are and why they matter.
Sounds good. Let's dive in. So the basics first. Nostro. It's Latin. Means ours.
Ours, okay.
In banking terms, a Nostro account is, well, it's an account that our bank, let's say a U.S. bank, holds in a foreign currency.
Like, say, Japanese yen.
Perfect example. So an account in yen held at a bank in Japan. That's the U.S. bank's Nostro account. Our money over there. Okay, I think I'm following. Like, if my local coffee shop wants to buy beans directly from Colombia, they need to pay in Colombian pesos, right?
Probably, yeah.
So my coffee shop's U.S. bank wouldn't physically send pesos. Instead, that U.S. bank would likely use its Nostro account, its peso account, held at a bank in Colombia to make the payment.
Precisely, you've got it. And just to complete the picture, from the Colombian bank's point of view...
Let me guess. It's the opposite.
Kind of, yeah. They see that account, the one the U.S. bank holds with them, as a Vostro account, Latin for yours. It's their record of the U.S. bank's money.
Nostro is ours, Vostro is yours.
Got it. So why this whole setup? Why not just, I don't know, swap dollars for pesos every single time someone needs to pay?
Well, think about the sheer scale. Billions, maybe trillions, moving across borders daily. Doing a direct currency exchange for every single little payment would be incredibly slow and really inefficient.
Right. Too much friction. Exactly. Nostro accounts streamline all that. Banks can settle payments within a currency zone using the funds they already hold there. It makes international trade and finance flow much, much smoother.
And our sources mentioned SWIFT in this context, too. How does that fit in?
Good point. SWIFT is essentially the messaging system. Think of it like the secure email network banks use to send instructions about payments.
So SWIFT carries the message like, pay this company from our Nostro account.
Exactly. It tells the bank holding the Nostro account what to do. But SWIFT itself doesn't hold or move the actual money. The money movement happens between the Nostro and other accounts.
Okay, that clarifies the SWIFT part. Let's walk through a payment then. Say a company here in the U.S. needs to pay a supplier in Germany, in euros.
Okay, so the U.S. company tells its U.S. bank, pay this German supplier X euros.
Right.
The U.S. bank then sends an instruction, probably via SWIFT, to the German bank where it holds its Euro Nostro account. Telling it to debit the required euros from that Nostro account, are euros held there, and credit them to the German supplier's bank account, which is likely also within the German banking system.
So the euros basically move from one German account to another German account, even though the instruction came from the U.S.
Precisely. No euros had to physically or even digitally in a complex way cross the Atlantic for that specific transaction. It leverages the pre-existing pool of euros the U.S. bank holds in Germany.
That makes sense. Much more efficient.
It underpins almost all international trade, really.
Okay, but the sources also highlighted a darker side, the connection to money laundering. How do these essential accounts become, well, vulnerable?
Yeah, that's the unfortunate flip side. The same complexity and interconnectedness that brings efficiency can also be exploited. You have multiple banks, multiple jurisdictions, correspondent banking relationships where banks rely on each other's networks.
Making it harder to see where the money originally came from.
Exactly. Illicit funds can be layered through various accounts and banks across borders using these Nostro-Vostro networks. And the sheer volume of legitimate transactions passing through makes it challenging to spot the dirty money hidden within. It's like finding a needle in a haystack sometimes.
So the system's own scale and complexity can provide cover.
That's a good way to put it. While absolutely vital for clean finance, the structure can be misused if banks aren't vigilant.
And that's where things like Know Your Customer Rules, KYC, and anti-money laundering AML regulations become so critical.
Absolutely essential. Banks have to conduct thorough due diligence. They need to know who they're dealing with, understand the nature of the transactions, and have robust systems to monitor activity within these Nostro accounts for anything suspicious.
Constant vigilance, basically.
It has to be. It's a continuous challenge for compliance departments.
Okay, before we wrap up, let's boil it down one more time. The simplest way to think of a Nostro account.
Just picture it as your bank's wallet holding foreign currency kept safely at another bank overseas in that currency's home country. Our foreign wallet over there.
Perfect. So, key takeaways. Nostro accounts are the workhorses of international payments. They make cross-border settlements way more efficient.
But efficiency and complexity can also create vulnerabilities that criminals try to exploit for money laundering, demanding strong regulatory oversight.
Right, which leaves us with something to think about. As finance gets ever more digital and interconnected globally, systems like Nostro accounts are crucial. But how do we keep balancing that incredible efficiency and opportunity against the very real need for security and effective regulation everywhere?
That's the ongoing challenge, isn't it? Balancing global flow with global security.